Hey option traders, with Affirm Holdings set to report earnings after the close Thursday, some analysts foresee the company beating and raising guidance. While the stock has been an underperformer in the last few months, investors could consider an earnings play, as earnings events often catalyze a dramatic move higher or lower. Currently, option traders are pricing in a 20% move on Affirm's report. This means that premiums on put and call options are extra expensive relative to the norm. This is due to the uncertainty around the earnings announcement. One way to take ownership of a stock for less than the current stock price is with an option strategy called a cash secured put. Cash secured put is a slightly less bullish trade than buying the stock outright. A cash secured put involves writing an at the money or out of the money put option and simultaneously setting aside enough cash to buy the stock. The goal is to either have the put expire worthless and keep the premium, or be assigned and acquire the stock below the current price. Selling put options is an easy place for investors to start. They're kind of like covered calls and are easy to understand once you know the basics. Traders selling puts should be aware that they may be assigned 100 shares of the stock at the strike price of the option contract. So let's take a look at the option chain and set up this trade. So here we are on my dashboard. First thing, type in AFRM, which is the ticker symbol for Affirm. You're going to want to select a spread type as single if you're trading on Thinkorswim. And we're going to want to look at the February 18th expiration. And we're looking to sell a put with a strike price of 52. So we're going to be clicking on this strike price here, and on this side of the screen, where is displays the prices for put options. And to recap, we are looking to sell a February 18th 52 put. By selling this put, you would receive $235 into your account, and this premium would be yours to keep. If Affirm falls below 52 by February 18th, you'd be required to buy 100 shares at $52 a share. The effective net cost would be $49.65 thanks to the premium received. If the stock stays above 52 at expiration, the put expires worthless, leaving the trader with a 4.7% return on capital at risk. That works out to be nearly 192% annualized. The main risk with this is similar to owning stock. If the stock falls quickly, the trade will suffer a loss. However, the premium received will help to offset that loss. The maximum loss on the trade would occur if Affirm fell to zero, which would see the trade lose $4,965, but most traders would cut their losses before then. Cash secured puts are a great way to generate return on strong stocks, potentially without ever having to take ownership. If the put does get assigned, the investor takes ownership with a reduced cost base and can potentially begin selling covered calls to generate additional income from the position. And there you have it, this week's option trade in Affirm stock. As always, remember that if you're new to options, make sure you practice with a virtual trading account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.